From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, a week of economic data sets the stage for the Fed to start cutting rates. Now, the question is, how big will Jay Powell and the central bank go? 25 or 50? And we're going to catch up with Akila, Grewal, partner and global head of credit product at Apollo Global Management. There's been a lot of news coming out of that shop. But first, we're going to begin with the big issue, debating the Fed's path ahead.
The market participants are still trying to gauge, is inflation still back in the box?
Overall, it looks very well controlled to me.
We're quite comfortable with an inflation rate in the 2 to 3% range.
Inflation, it's gotten a lot better. It is going in the right direction.
People are worried that the economy is slowing and inflation isn't slowing fast enough.
We were expecting slightly lower print last month.
I think it maybe was a little bit of a shock to some people in the market that inflation could still be a concern.
It holds the Fed back. I think we get 25 basis points this month for a cut.
Inflation today at the margin is tilting investors towards 25 basis points in September.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week.
So while the Fed's focusing on the labor market, they're not going to forget about inflation. So I think it's going to limit the flexibility that they have.
We may have a slow start to Fed cuts if inflation remains sticky.
Now, we're pretty much looking at a coin toss in the markets between that 25 or 50 basis point rate cut. Traders are boosting the likelihood of a 50 basis point rate cut to more than 40%. And remember, that was an outcome that just days ago seemed like it was off the table. The Wall Street Journal's reporting that the Fed's decision is a close call hinges on this one question. Do they start small or begin big? Of course, whatever they choose to do with that first cut will set the tone for the path ahead. Mohamed Al-Arian warns of that potential volatility coming up.
We have a major reconciliation in our future. We have the treasury part of the fixed income market that is signaling quite a high probability of recession. We have the credit part of the fixed income market that is signaling a very high probability of a soft landing. Now, if liquidity doesn't reconcile these two things, there's going to be even more volatility in this marketplace. And at some point, volatility spills back to the real economy.
Joining us now, Gennadiy Goldberg of TD Securities and Brandywine's John McClain. And Gennadiy, if you think about exactly what has changed over the last 24 hours, it's not the economic data so much. You did get the University of Michigan sentiment data, but that confidence that you saw in the data would have supported a 25 versus a 50 basis point cut, would it not? So why do traders still believe that 50 is so on the table?
Well, there's been some reporting out of the Wall Street Journal that I think has driven some of the market pricing. Right now, we're in the media blackout ahead of the Fed meeting. And unfortunately, information vacuums breed uncertainty. And this is exactly what we're seeing. The market is questioning whether, the Wall Street Journal knows something that the rest of us don't. They're questioning, this is exactly what happened ahead of that June 2022 meeting where the Fed actually kind of let the journal in on a little bit of, information ahead of the meeting. The problem is I don't think there's anything new in that story. So fundamentally, nothing has changed.
So, John, how do you see this going? What would it say if the Fed were to cut 50 basis points?
Well, we don't think the Fed is going to cut 50 basis points. And we think if they were to do so, again, that's like shouting fire into a crowded movie theater. There's no reason to be doing this at this point. The data supports 25 basis points, and going slow and steady, we think, makes sense.
At the end of the day, if they went 50, and the reason I ask this so much is because the odds in the market seem to be rising, not fully favoring that direction, but closer to it than they were before. Could they go 50 and then go 25 after that, Gennadiy?
Well, I think that's the difficult thing to communicate, right? How do you tell the market, oops, we're starting really late, so we're going to go a lot faster, but the next couple are going to be slow, so don't worry about it, but we're also going to be data dependent, right? That tightrope is extremely tough to walk. So what they want to do is tell us, look, we're going to start gradually. If we need to go faster, we can certainly go faster. I think what's more likely is they go 25, keep the door open for 50s, so that if the next two payroll reports after the September meeting, let's say they weaken, we could certainly accelerate into a 50 basis point a meeting pace if it's necessary, but not necessarily right now.
So then, John, to that effect, do you believe that that could be the case as well? What does the labor market look like to you that would justify even those 50 basis point cuts later on in the year?
Well, yeah, I mean, look, the labor market is certainly softening, and we're getting a lot of micro data from companies talking about the low-end consumer particularly struggling, and the middle-income consumer is really starting to suffer in terms of wages relative to what we've seen in inflation. But I think the logical is exactly what was just discussed, which is start with 25, see some more data. We talk about being data dependent. And if the data continues to soften, then you can hit the accelerator. But starting at, going from 0 to 60 feels like it's probably not the right course. And I think the market will actually interpret that negatively. I would expect stocks to sell off if we start to see a 50 basis point in September.
Listen, this dispersion is huge. We've been talking about how this is essentially a coin cost in the markets. When you think about what Bill Dudley has said recently, he's on the other side. He thinks there's a strong case for 50. He says that he knows that that's what he would be pushing for. It's basically up to Chairman Powell to see how much support he has for being more aggressive. When you read the tea leaves across the other members of the FOMC here, Gennadiy, is there more support to be more aggressive?
I don't think so. I mean, they're certainly keeping the door open. If the economy slows down, if the labor market really starts to slow down, they can certainly go. But we had Governor Waller speaking on Friday, President Williams speaking on Friday, President Goolsbee speaking on Friday. If ever there was a chance to drop a hint, that would have been it. None of them really pounded the table on a 50 basis point cut. Governor Waller initially seemed to be a little bit more in favor of it, but if you read his speech closely, he was talking about accelerating from 25 per quarter to 25 per meeting. That's not exactly anything new. So at the end of the day, I think they've had their chance to drop the hint for a 50. If they choose to push markets that way, they could have certainly done it. I think the market right now is just trying to trade the information vacuum.
Now, it's interesting, John, when you look at the 2-year, for example, it has pushed below that 360 level. As I speak to you right now, we're at 359, essentially, 5 basis points lower, even after that University of Michigan data. What am I not seeing here? Because we have the consumers saying that they believe that inflation is really moderating enough to feel good about the outlook of things. You understand here, yes, the labor market is cooling, but if the consumer feels okay, then what's the worry?
Well, I mean, look, I do think the worry is in the slowdown of the consumer, and the worry is that we are coming off of unprecedented fiscal stimulus and very high inflation. And so we're trying to stick a soft landing here and getting a little bit cute with monetary policy, frankly. So, I think you look and see 9-10 cuts priced in over the next 12 months, and we think that is far too aggressive in terms of where the Fed is. But that's why the 2-year is where it is today. Is the expectation the expectation that we get ahead of things.
Would you buy at these levels?
No, I'd be fading this here. I mean, I think the front end has reacted to kind of where they think the Fed's going to be in a couple of years. And the back end's really tricky here because we have no term premium baked in.
So, Gennadiy, speak to that as well. How do you think about the differentials between what you're seeing in the front end and the long end, and how you would position from here?
Yeah, I mean, I think I agree, John. I mean, it's tough to chase this rally. I think most investors I've spoken to don't want to be chasing this move in rates. Stepping back, I think what we're seeing right now, very importantly for the Fed, is an easing in financial conditions. That's something I don't hear talked about enough, is that if you look at financial conditions just across any index, whether it's the Bloomberg one or any, pick your index, all of them are really pointing towards an easing in financial conditions, and that's huge, right? A lot of that is long-end interest rates coming down, short-end interest rates coming down. We're looking for the 10-year to finish the year at 3.4%. We're looking for the 10-year to hit 3% by next year. That's assuming a relatively soft landing. If we get a harder landing, you're probably not going to get that good of a print. We can keep going and rates can actually fall further. But in the short term, I think there's a lot of investors out there who are very concerned about chasing this too far down.
Well, you look at Fed swaps, you look at even the spot market when it comes to treasuries. Question for you, Gennadiy. Do you think, and an investor brought this up to me this week, that what's being priced in here is not as much a reflection of where they think the Fed is actually cutting, but just a risk premium that is baked in that things could be worse than you think it is?
Absolutely. I mean, it's the same reason we have our forecast for the end of next this year at 3%, when our forecast for Fed funds is at 3% as well. That's not something you typically have. That's an absence of term premium that you only have when the market is expecting something bad to happen. So, we always have to think about this as a range of possibility. You've got a soft landing as the base case, but as you keep getting this weaker and weaker labor market data, the fear is, it's kind of death by ice, effectively. It's a cooling over the labor market to the point where the economy slows and rates continue to pencil in some chance of a recession. And I think that chance is gradually rising as the data comes in.
John, what is the probability you place here on a chance of a recession and how hard it could be?
Well, I mean, I think the chance of a recession is reasonable, probably 20-30%. But I think really the issue is that companies' balance sheets are fortified at this point in time. So a garden variety recession isn't going to be materially impactful to the corporate bond market, which is where we're really paying attention. So we think, look, a recession could happen, but companies have been thinking about a recession since 2022. So the balance sheets are strong.
A very large investor telling me this week that perhaps we already had our recession and we're in the beginning of a 7-year bull cycle. The market will certainly show its face at some point. Gennadiy Goldberg of TD Securities and Brandywine's John McClain, we thank you so very much ahead of a very critical Fed meeting, historic really, that could set off a rate cutting cycle. Let's see how easy that goes, though. Up next, the auction block. Hewlett-Packard Enterprises raises $9 billion, which is pushing this week's sales past forecasts. We're going to talk credit next as this easing cycle begins. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where the pace and demand for global debt sales remain strong. Over in Europe, Italy's 8 billion euro 30-year sale attracted over 130 billion euros worth of orders as investors rush to lock in the region's highest yields. Monthly sales now top 100 billion euro. And in the United States, Hewlett-Packard Enterprises and Citigroup led the way for high-grade sales this week. Around $38 billion was sold in total, which pushes the year to date total past $1.2 trillion. Over in high yield, the week's issuers count hit 15, making it the busiest period since May. By number of issuers, Tuesday was the busiest day this year. And private markets were also part of this week's sales. Blue Owl and Sixth Street both had offerings. Blue Owl selling $1 billion, adding to the record-setting pace this year for private credit funds. We're going to stick with credit, bring in Akila Grewal, partner and global head of credit product at Apollo Global Management. A lot in the news about Apollo this week alone, but let's start here with the environment. This idea that we are on the precipice of a historic rate cutting cycle. What does this mean? We've seen a flush of issuance come out this year in anticipation of just this moment, people looking to lock in those better rates. What do your conversations with clients look like?
No, thank you, Sonali, so much for having me. And absolutely. So I think, like you had on your prior segment, the market is obviously pricing in additional rate cuts to happen over the course of the near term. I think remains to be seen whether that'll be 10 over the next 12 months, but equally, there likely will be some compression in rates that we're all expecting. That being said, when you think about rates today, it's still elevated versus where we've been for the last 10 years. And so investors are still very much focused on getting exposure to credit because from a total return perspective, from a yield perspective, you're still getting really attractive risk-adjusted returns.
We seriously hear that a lot, whether you go into credit markets as opposed to what you're seeing in treasuries for that extra yield. What does this mean for public versus private credit? Where does the investor demand go as you see the rate cutting cycle start to begin?
No, it's a great question, and we get it a lot. Obviously, liquidity has continued to be a focus from investors, particularly given the rise of private credit. And you've heard Apollo or others talk about how historically public credit was associated with good and liquid, and now private credit sometimes has a misnomer of being bad and illiquid. I think we're going to continue to see a convergence of those two markets, and we can talk about that more. But equally, I think from a public market perspective, it's also a tale of two cities, right? You have really liquid parts of the top end of the market, larger issuers, new issuance that you mentioned, and then when you go down to legacy exposure or more smaller companies, you actually have a lot of illiquidity in the public market. And the liquidity premium for public markets has actually near or about historical lows, whereas in the private markets, our expectation of what we're seeing is in sub-IG, you're still getting about 200 basis points plus for private credit vis-a-vis public. And in investment grade, you're actually almost doubling the spread that you can get in the public market. So at least for now, it still feels like private credit is a relative value that you want to play.
So this is fascinating because we, of course, reported this week that Apollo is partnering with State Street. You're looking to provide a private credit access in the form of an ETF. I know you can't talk about the filing itself, and also this idea that we reported on that Apollo is creating a trading desk to make this possible to begin with. But talk about the concept here. How liquid can these markets really get? I mean, what does all this retail access mean for the industry? Does it make the private markets look much more like the public markets anyways?
No, it's a great question, and you're right. I'm limited in what I can say, but equally, State Street is a leading asset manager. We're thrilled to be partnering with them. We can't say too much at the moment, but I think thematically at a high level, you've heard our CEO, Mark Rowan, talk about this convergence between public and private. This is emblematic of that in our view. I think you'll also continue to see, and there was news today as well, of traditional and alternative asset managers partnering to kind of bring broader access of alternatives to these more liquid type of structures. And I think that, Apollo is getting engaged in this facet, as well as thinking through what do we think about investment grade markets, generally speaking, and should there be a bifurcation, or are they coming together in terms of liquidity?
How do you think about this in terms of risky versus not risky? Apollo, of course, the old legacy of Apollo is in distress. The new legacy of Apollo is in investment grade credit. And so when you think about those companies that are still feeling the strain of higher rates, to your point, rates may stay elevated.
Right.
How many companies are still going to feel that pain if we don't see those 10 rate cuts? How does Apollo handle that?
I think you're spot on, and I think to your point, legacy Apollo, new Apollo, but we can debate. I think equally Apollo's credit business, as you well know, is very much focused on still high quality, top of the capital structure, secured type of risk. That doesn't mean that there won't be opportunities for opportunistic and hybrid businesses to delve into some of those situations. As you know, right, I think JP Morgan reported there was $50 billion worth of distressed activity over this year, which is incredibly high, and you're seeing that really in the floating rate market more than the fixed rate market, to your point on rates. And so I think what Apollo is going to try to do is focus on still high quality companies, fundamentally sound companies that may need additional structuring, LME or otherwise, and that are focused on good company, maybe suboptimal balance sheet, versus diving down into kind of, in our credit business, suboptimal company and suboptimal balance sheet.
What does this say about kind of what's coming to market right now? Because when you look at credit spreads, they are still so tight that you could argue that most investors are sitting around and ignoring the risks in the credit market. Yeah. But then you see bankruptcies also hitting the tape very significantly. So what is Apollo seeing kind of on that falling angel end of the spectrum? Are you seeing kind of a lot of companies out there that you just wouldn't touch at this point, given where we are in the economy?
I think in the high yield market, yes. I mean, the CCC market is difficult to kind of get engaged with. Not to say that we would never, but I think we're going to definitely be much more focused on picking our spots. And to your point, high yield spreads are where they are. If you take out the bottom 20%, you kind of have a really historical tight, what we've never seen in terms of high yield spread. So it's definitely going to be about picking our spots.
So private credit once more, because I think this is an interesting aspect for all credit investors. Access is being made as we speak. But what does this mean in terms of future interest? As rates go down, how much interest will there be in private credit? Given so many instruments have been floating rate, you've seen also a lot of pressure on investors. That has been made fundraising, that hot fundraising we saw at the beginning of the year, start to taper off now. So where's that extra interest coming from, and what does that look like as rates start to subside?
No, it's a great question, and I think you've heard us talk about this before as well, but the wealth and high net worth, and retail market, I think, is incredibly instrumental in our growth, and candidly the alternatives growth more specifically. It's a $200 trillion market, 5% in alts. And so if you believe that they're going to continue to diversify, get additional sources of income, additional sources of exposure, and really try to lean into the alts market, whether it's the announcements that we talked about earlier or otherwise, that's going to be a big area of growth for us. And I think equally on the institutional side, we speak to investors all the time. There's still a number of investors who are early in their private credit exposure days. And as we kind of take a step back and you think about return targets for a long time haven't really changed in terms of what investors are seeking to achieve. And when rates were zero, they leaned to more equity or higher risk strategies. Today, when rates are not zero, higher than zero, you're seeing people move across the risk curve.
What is it actually being offered to these retail investors? Because it's not like when they are investing in private credit, they are investing in, the next leverage buyout, right? Yes. I mean, what are the kinds of things that are being placed into those private credit portfolios?
Great question. I think it's about semi-liquid products that allow investors to get
mortgages.
Yeah, mortgages. We can talk about in asset-backed finance. It's mortgages, it's resi, it's consumer. It's a diversified approach to everything that we're doing across the origination channels in various product forms.
About 30 seconds left here. What's the single biggest question your investors ask you right now?
I think the single biggest question is where are the unintended risks that I'm taking in my portfolio and how do I mitigate against it? And a lot of what we've been talking about with investors is shifting your private credit allocations to investment grade as well to start thinking about a holistic fixed income portfolio, which is a big theme of ours.
Akila, we thank you so much. That is Akila Grewal of Apollo Global Management. And still ahead, the final spread, the week ahead, it is the big week. A Fed rate decision just around the corner. We're going to talk about those expectations next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, you have PIMCO CEO Manny Roman speaking on Bloomberg Television. You're not going to want to miss that. Plus, U.S. Empire Manufacturing. Tuesday, the latest retail sales print, and we're going to hear also from J.P. Morgan CEO Jamie Dimon. You may remember he's believed in higher rates for a long time. Let's see if he still does. Wednesday, a Fed decision and Chairman Powell's news conference, the big moment of the week. And Thursday, another round of U.S. jobless claims, existing home sales, and a Bank of England decision. Finally, Friday, it's the Bank of Japan's turn for a rate decision. Plus, we'll hear from ECB President Christine Lagarde. For my final thought, let's take a look at those central bank decisions around the world. Of course, remember, because we have U.S., Brazil, and Indonesia on Wednesday, UK, Norway, Taiwan, Turkey, and Ukraine, and then Japan, I'm watching, of course, U.S., the UK, and Japan to watch all of those differentials. Remember, the story on Wednesday could change drastically by Friday because of that carry trade and just how hawkish Bank of Japan's governor has sent signals into the market, already setting some jitters in the market this year. Now from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.